Good day, everyone. In this chapter, we will discuss financial planning and budgeting. Financial planning begins with determining what the company wants to accomplish and identifying the actions needed to achieve those objectives. One important part of planning is comparing planned performance with actual performance. When differences occur, management analyzes the variances and determines what improvements should be made in future periods. The chapter also introduces the long-range plan. Generally, a long-range plan covers a period of 2 to 5 years or even longer. Unlike a short-range plan, it does not require the same level of detail. Instead, it focuses on broader conditions that may affect the organization in the future. These factors include people's needs, the composition of top management, political stability, long-term financial conditions, and long-term organizational objectives. Long-range planning is more difficult because management is attempting to predict conditions several years ahead. Therefore, it is naturally more exposed to uncertainty and error. However, long-range planning remains important because it provides direction for the organization's long-term goals. The plan is also not permanent. It is normally reviewed and revised as new information and perceptions about the future become available. Once the short-range and long-range plans have been prepared, the company develops its financial plan. A financial plan can also be viewed as a budget. Budgeting is the process of translating planned courses of action into quantitative terms, especially monetary terms. In other words, the financial plan formally expresses what the company expects to accomplish in terms of sales, expenses, production, financial transactions, and other activities during a specific period. The financial plan has several important functions. First, it directs the firm's operations by providing financial targets. Second, it serves as a control device. Actual operating results are collected, summarized, and compared with the plan. When significant differences occur, management investigates the variance and takes corrective action when necessary. Third, the financial plan provides a basis for measuring periodic or annual performance. The chapter also presents two approaches to financial planning: zero-based budgeting and incremental-based budgeting. Under the zero-based approach, the budget starts from zero. Managers must identify activities requiring funding and justify the expenses. Under the incremental approach, the current budget begins with the previous year's budget, with increases or increments justified based on current needs and conditions. Financial planning performs three major functions: planning, coordination, and control. First, planning helps management determine objectives, identify possible courses of action, and establish priorities. The organization uses the financial plan to work toward its desired position. Second, financial planning promotes coordination. Different departments may have different responsibilities, but they must work toward common organizational objectives. Financial planning creates a connection among these departments and helps them communicate their activities and requirements. Third, financial planning provides control. Management compares actual performance with planned performance. Differences are analyzed to identify areas that require improvement. The financial plan can also be used to evaluate individual departments or managers. The chapter then introduces the master budget. The master budget is the combination of budgets prepared by different units of the organization. It provides an overall financial and operational plan and serves as a control measure. One important component is the sales budget. The sales budget represents the planned volume of products the company expects to sell based on the sales forecast. It is important because many succeeding budgets depend on expected sales volume. For example, Lucky Merchandising expects total sales of 5,050 units at a selling price of 120 Cuban pesos per unit, producing total expected sales of 606,000 Cuban pesos. After preparing the sales budget, the company prepares the production budget. The production budget determines how many units must be produced to satisfy expected sales while maintaining the desired ending inventory. The basic relationship is planned sales plus desired ending inventory minus beginning inventory equals required production. Once required production is determined, management can calculate the amount of direct materials needed. The direct materials budget determines the materials required for production and the quantity of materials that must be purchased. In the Lucky Merchandising example, the company requires 3 pounds of materials per unit. The desired ending materials inventory is based on 15% of the next quarter's production needs, while the fourth quarter ending materials inventory is set at 600 units. Inventory planning is important because too much inventory creates storage and carrying costs and ties up resources. Too little inventory can cause production interruptions, lost sales, and an inability to satisfy customer demand. The chapter also presents the schedule of expected cash payments for materials. Purchases may not be paid immediately. The example assumes 75% of purchases are paid during the quarter and 25% during the following quarter. Therefore, the materials budget tells us what to purchase, while the cash payment schedule tells us when those purchases will actually be paid in cash. The direct labor budget determines the amount of labor required to meet production requirements. Management must know whether the available workforce can produce the required number of units. If labor requirements are ignored, production problems may occur, which can eventually result in lost sales. The calculation follows a simple sequence: units to be produced multiplied by direct labor hours per unit gives total labor hours required. Total labor hours are then multiplied by the direct labor cost per hour to determine total direct labor cost. In the lucky merchandising example, each unit requires 6 labor hours, and the total production requirement is 5,070 units. Therefore, total labor requirements amount to 30,420 labor hours, with total direct labor cost of 243,360 Cuban pesos. Next is the factory overhead budget. Factory overhead includes manufacturing costs other than direct materials and direct labor. Examples include indirect materials, indirect labor, power, fuel, supplies, small tools, depreciation, insurance, rent, taxes, maintenance, and repairs. Factory overhead is divided into variable and fixed overhead. Variable overhead changes with production activity, while fixed overhead does not directly change with the production level. Finally, the ending inventory budget determines the cost of unsold units. The unit manufacturing cost combines direct materials, direct labor, and variable factory overhead. In the example, the variable manufacturing cost per unit is 78 Cuban pesos. The selling and administrative expense budget identifies operating expenses that are not part of manufacturing. These expenses are classified as variable or fixed. Variable selling and administrative expenses change in relation to sales volume. In the example, the variable expense is 6 Cuban pesos per unit sold. Fixed selling and administrative expenses remain unchanged within the relevant operating capacity. The example provides fixed expenses of 12,000 Cuban pesos per quarter. An important point is that non-cash expenses are excluded when calculating estimated cash payments because they do not represent an actual cash outflow during the period. The chapter then introduces the cash budget, which is one of the final stages of budget preparation. The cash budget determines whether the company will have enough cash to meet its obligations. It is particularly important because the timing of cash inflows and outflows may be different. For example, the company may need to pay suppliers before collecting cash from customers. The cash budget has 4 major sections: cash receipts, cash payments, cash surplus or deficit, and financing. If the company has a cash deficit, it may need short-term borrowing. If it has a surplus, management may use the excess cash to pay obligations, invest in other activities, pay dividends, or maintain cash reserves. The cash budget therefore helps management avoid both cash shortages and excessive idle cash. The final part of the budgeting process involves preparing the budgeted income statement and budgeted balance sheet. The budgeted, or pro forma, income statement summarizes the expected revenues and expenses resulting from the various budgets. It provides management with an estimate of expected operating performance and also serves as a control device because actual results can later be compared with budgeted results. In the lucky merchandising example, expected sales are 5,050 units at 120 Cuban pesos, resulting in sales of 606,000 Cuban pesos. After deducting variable costs and fixed expenses, the company arrives at income before tax. After interest expense and income tax, the example produces net income of 49,205 Cuban pesos. The budgeted balance sheet presents the company's expected financial position at the end of the budget period. It starts with the previous year's actual balance sheet and adjusts the accounts based on the different budget schedules. For example, ending cash comes from the cash budget. Raw materials and finished goods inventories come from the ending inventory budget. Accounts receivable are affected by sales and expected cash collections. Accounts payable are affected by material purchases and cash payments. The budgeted balance sheet is useful for checking the accuracy of other budgets, determining the expected financial position, computing financial ratios, identifying possible unfavorable conditions, and supporting forward-looking decisions. The major lesson is that the different budgets are interconnected. Sales influence production, production influences materials and labor, these affect expenses and cash, and all of them ultimately contribute to the company's projected financial statements.